pitching VCs when you're not raising capital is a bad use of time. I think the best thing to do is when you are raising capital, meet VCs that are at your stage and cultivate those relationships. Founders can take this approach of, well, no business is perfect. We're not gonna be explicit about maybe the things that are not working well. And I think that's totally the wrong thing to do. What you want to do is control the narrative. Say, hey, look, this is what's compelling about the business. By the way, here's what's the challenge. Here's my plan.
Gautam, thank you so much for joining our podcast today. You're a partner at TCV, which is an early stage and growth equity investor with an incredible 21 billion asset under management. And so happy to talk to you today.
Yeah, it's a pleasure to speak with you, and thanks for having me.
Tell me, what type of companies and business models and geos are you currently looking for to invest in?
So we're a multi-stage firm. So TCV invests from Series A all the way through public markets. My focus, and also globally, my focus is really on North America early stage businesses. Anything, Series A, Series B, Series C. Think of it as kind of first revenue all the way through $20 million of revenue. And we tend to have a pretty active position. And so, we do take board seats and tend to lead rounds, but, have a lot of flexibility in our mandate to be able to participate in rounds, and just be very flexible in terms of the types of investments we make.
Do you have some kind of preference for business models or sectors right now? Like fintech, enterprise SaaS, AI, Gen AI, etc.?
I would say because we're generalists, we invest across a variety of business models. So we do a lot in SaaS. We also do a lot around consumer businesses and B2B2C. We're quite, sort of agnostic relative to the actual business model. It's really about finding a founder that we, think can, is compelling and think has a big vision and can build a big company. Hopefully a business model and a sector that we understand and that we know. And then the early signs of product market fit.
Yeah, right. And so what type of product market fit signals are you looking for? Because as you said, you are also investing into pre-revenue companies.
Obviously, product market fit can be very difficult to define. And, it's kind of one of those things. I think if you ask someone, they'll say, well, I'll tell you when I see it. Honestly, the biggest things for us tend to be, one, voice of the customer. So we do a lot of customer calls, trying to understand customer feedback. And trying to understand, is it something that the customers can't live without, right? So one aspect is just the voice of the customer and the customer feedback. The second is the quality of those customers, especially in an enterprise business. We're less concerned about, do you have 10 customers, 15 customers, 50 customers? It's more about the quality of the logos and, those companies being sort of the, trendsetters in a market or in an industry. And then I would say the third thing is we look for, signs that the go-to-market can be repeatable, right? Things like, is your pipeline starting to inflect? Are your win rates starting to inflect? Things like that.
For example, imagine you have a pre-revenue startup or a startup who has only got the first 3-5 paying customers. So there's not tons of data on which you can make a sound investment decision, at least based on financial information. Do you do some kind of customer acquisition costs or customer lifetime value predictions in order to strengthen your model and own decision?
Yeah, so we do sort of a lifetime value analysis. The challenge though sometimes, and depends on the stage of the business, right? But sometimes you may not have a lot of data on retention rates and renewal rates. And so, the lifetime value may be less predictive because you haven't been through a renewal cycle. You don't know, maybe the pricing model really doesn't have any way for there to be NDR or, customer growth. And so what we tend to focus more, and by the way, this goes for both consumer and enterprise businesses, is just the efficiency of go-to-market and the payback. How quickly are you able to pay back on the customer acquisition cost? And it's obviously the earlier the business, the less precise some of those metrics are. So you're certainly making a bit of a bet on what you think is possible. You're betting on the quality of the team, the go-to-market team. And then that's where also the customer feedback comes into play, right? Because if you're able to talk to a customer, even if they haven't gone through a renewal cycle, but
Yeah.
they're, saying, hey, I'm a 10 out of 10 on this product, and this is, fundamentally changed the way I do business. That's obviously going to be a very positive sign for renewals.
Because if I'm looking at pre-revenue startups or very, very early startups, and I want to assess like, okay, how big can this be and how profitably can this scale? Here's what I would expect many VCs would be doing. For example, if there's a specific target market with a specific ICP targeted for solving a problem, and there are some kind of playbooks. So you could talk to the founder of, okay, what are the main, for example, lead generation channels that you think you will be doing? And then maybe I would have internally some kind of benchmarks, which are not 100% correct, of course not. Yeah, but if the person would say, okay, we would be doing manual email outreach, for example, yeah, then I would have maybe some kind of benchmark for other B2B companies and say like, okay, typical customer acquisition cost would be 100, 500, whatever. I don't know. If you're talking to the like 10 lighthouse customers that the company is maybe already working with, really trying to understand what is the financial value that you are creating for as a startup for this type of customer. Maybe doing some kind of an ROI calculation or so, even if they do not monetize it right now. Yeah, I mean, maybe they are just offering the service, providing great value, but they are so early they did not even think about a smart pricing model yet, because this was not the focus. The first focus was to, okay, we need to solve a problem and find value that we're delivering, and then afterwards we are capturing it. So that's why I would expect that many professional investors are then doing this kind of. I mean, of course, they are very inaccurate. So because those are predictions, yeah, and you have lots of uncertainty involved in it. But just targeting a big market or so and saying like,
Yeah.
oh yeah, it's a multi-billion-dollar market, it's not enough from my point of view. Because, I mean, if you want to do some kind of IRR calculations for your own fund when you deploy capital, you would also want to feel more safe, definitely, and say like, okay, what is the probability of us making good return on the deployed capital? And so that's why the question is, how do you in the real world can you share with other founders of how you're assessing in a given world of very much uncertainty the LTV and CAC information for very early startups? And I'm not talking about
Yeah.
Series
Yeah,
B or so,
totally.
because then you have enough data and then you can run very simplistic financial models. But before that,
Yeah, totally. I think one of the big things comes back to this concept of benchmarking. So I think one of the sort of best ways that a founder can go about, presenting this is you're trying to find benchmarks, and KPIs of competitors or even businesses with maybe a similar ACV or selling to a similar ICP, right? And be able to say, hey, this is what that funnel, like these are the data points I've been able to gather.
yeah,
This is what that implies about the funnel, right? And conversion through the funnel. And so therefore, based on maybe the early data I have around,
yeah,
how much it's costing me to generate a lead or what my win rate is, from
yeah,
demo to close, I can
yeah,
recreate this funnel using industry data and industry benchmarks. So I
yeah,
think that's the best and the cleanest way that
right.
avoids this like kind of making up, data on
Yes.
the fly.
I mean, making up data is the worst thing that you can do, and then hurting the trustful relationship between a startup founder and a VC. So, for example, if the founder is presenting you with some benchmarks and you think like, oh, the market looks very interesting and the benchmarks look promising, but of course, there is execution missing because this is only raising money for getting to the next milestone, which includes
Yeah.
executing, for example, executing the go-to-market strategy. How do you make sure that those benchmarks are actually executable by the current founder team? Or if not, that you're putting some other talents into the company that are helping executing them and hitting, or maybe even yeah, hitting those benchmarks.
Well, I think one of the things, it's obviously very hard to know, right? If the
Right.
current team, can execute and to what level, right? Without seeing them execute for some period of time. And so the few things that we try to do, and then we can take the founder side of it, but the few things that we try to do is one, if we're able to track the company for some period of time before their fundraising, that's great because then you're able to see did the founders execute on what they told us, right? And are they building the team? What kinds of people are they hiring? The second thing is, we, in the process we like to introduce the founder to executives that could be advisors or full-time hires. And so we like to see how they interact with those folks, and what the feedback is from someone that maybe has scaled a business before, and can come back and say, hey, yeah, I think they're asking the right questions or they're thinking about the right things. Or, in some cases, wow, that call wasn't, like they're sort of not thinking about
Yeah,
the
that's
right
this.
areas. And I think for founders, the other way to approach it is, so one, sometimes you can't hire, sometimes before you get the capital, you can't afford to hire, the people that you want to hire and that sort of thing. And so that's where I do think an advisory board is really, not only great for the company, but it's a great sign for an investor to say, hey, this person is committed to bringing great people around the table, and they're able to attract talent, right, to work with them, even if it's on a part-time basis, right? It's like at least a positive data point. So I think that's one thing. The second thing is I do think often, when companies are raising capital, they're unprepared around what their hiring roadmap looks like, and even more specifically, what they're looking for in a given role, right? And so I think sometimes companies will have, like, maybe 50 to 70% of the time, a company will have a hiring plan, right?
Yeah.
At Series A. So that's great, right? Like, that's at least a start. I know what I want to hire, when I want to hire them. Most companies, though, don't have an idea. It doesn't have to be a fully built out spec, but they don't
Yeah.
have an idea of, okay, what is a successful candidate going to look
Yeah.
like, right? And I think that's where you can go one step further and really convince an investor that, like, you're being very thoughtful about hiring and building a team that can help you execute.
Totally agree. I mean, it's definitely not part of the pitch deck, but during the due diligence process or something like this, definitely would be helpful if you know, okay, what are you trying to use this money for? And then not only telling, okay, those are the main activities that one want, but also, like for example, those are the specific marketing campaigns we would like to run. Those are with this type of goals. Those are the specific product initiatives that we think, and those are the specific hires that we want to do, and then mapping those things to actually the functions in the business. And when I'm saying functions in the business, I'm not saying like sales and marketing because this is too generic, but I'm more like, okay, if you are thinking about customer acquisition and customer retention, for example, how is this person or hire improving the metrics along this type of funnel? Because this is, in the end, what those people should be optimizing for. They should not be hired. Oh yeah, we need a head of sales. Why? Yeah, because everybody is having a head of sales. Okay, great. So you're spending whatever, 200, 300K or something like this. What is the return on investment on that? Yeah. Ah, yeah,
Yeah.
okay. I don't know. Yeah, we will hire 10 sales reps as well. Okay. And how is this
Yeah.
growing the business? Yeah. So,
Totally. And I think a big part of that is like, what's the outcome that you want to get, right?
mm,
Which then informs the profile of the candidate that you need. There's a great book on this, just hiring process and like kind of a framework for think about hiring, called Who,
mm,
WHO. And I think it's Who, the method for hiring, or so subtitle is, but that's a great book that I recommend to founders, who are starting to think about hiring out or building out an exec team.
if you look at 100 founders that you are talking to and who are currently in the process of raising money, like let's say over the next 3 to 6 months, this is why I'm chatting with them. Uh, what is the percentage of those people having actually a clear path to growing the business? And what I mean by that is really like, not like, oh, we want to raise whatever, 2 million, 5 million, and so on, and we want to improve our product. Yeah, okay, that's super generic. Because many founders that I see on the internet or reaching out to me, they are very, very high level. So, and then I'm always
Hmm.
saying like, okay, how do you expect someone else to put in millions of dollars into your company if you are, even for yourself, do not have a clear path of how you want to grow the business to whatever, 5 million, 20 million, 30 million ARR, whatever. Of course, acknowledging that there's uncertainty. Of course, your plan will never be hitting the reality, or you will not hit the plan. But if you do not plan, at least you have some kind of good assumptions based on what you know or Yeah, but of course, the reality in 1 or 2, 3 years will be totally different because it's not only depending on you, but on your competitors and legal changes, the technology changes, etc., which you don't know upfront. So, what are the percentage of founders who have a very, very clear, detailed plan, which is validated? So, where we see like, oh, they don't just put in some bullshit assumptions, but they actually show,
Hmm.
okay, those assumptions based on our business or based on benchmarking or based on talking of us to like 10 industry experts or whatever. And the other way, other type of people who only have a high level idea of what they want to do with this type of money. And then actually you will think like, okay, this is just wasting my time. Maybe get back to us if you have a more clear picture of what you want to do.
I think it's more common at seed stage to find that maybe people don't have a plan or they haven't been as thoughtful about that. My sense of it is that by Series A, if you are gonna get a successful Series A done, you probably have to have, that plan and, have to be able to walk people through how you build the business. And then certainly by Series B, right? Like, I don't know that any Series B company, doesn't have like a model and projections built off of, real data in the business. So I think there's a transformation that happens between seed and Series A. And we might get to this later, but one of the things that I advise founders to do is after you raise your seed round, just build one slide, right? It doesn't have to be a full deck, but build one slide about the milestones that you
Yeah.
plan to achieve before the Series A, right? So that you know what the North Star, is for the business over the next 12, 18 months, whatever it is. And that way that guides the discussion of, okay, what are the key metrics that we need to hit? How are we going to
Right.
hit those? And you start to develop those muscles well ahead of when you're actually raising your Series A. And hopefully by that point, from an operating perspective, you're in a place where, you actually have a plan that you're working against. And this aspect of like goal setting and measuring and hitting financial KPIs is not new anymore. It's something that you've been doing for 3 or 4 quarters by that point, or maybe longer.
And if you are thinking about seed and early stage companies, what are the main red flags that you're looking for that could be a deal breaker?
At seed and series A, you're really trying to assess product market fit. And so, and quality of team, market dynamics, things like that. Some of this is out of the founder's control, right? Like the market, may be really interesting and then maybe 12 months later, less interesting. That's completely out of the founder's control. The quality of the team, the founder can't really change themselves, but they can obviously hire and bring people onto the team. But I think the biggest thing is just the science of product market fit. And where I think a lot of pitches kind of fall apart is, the product market fit just maybe isn't there, it isn't strong enough. Maybe one example from a consumer perspective is, you have a lot of users, no monetization, and, poor retention. Okay, well
Yeah.
that's going to be very hard, right? Or you have a lot of users but are paying too much to acquire them, and so the CAC LTV math just
Yeah.
isn't working, even if retention's maybe positive,
Yeah.
right? And so yeah, I mean, I think often a lot of why those conversations fall apart is something about the product market fit is just not strong enough. And then obviously, look, there are definitely a bunch of, maybe you don't believe in the founder or the market. There's concerns about how big is the market? Can it support a big outcome? Those are things that are just harder for the founder to control.
So imagine you have some early stage founders, and they have a runway of let's say 6 to 9 months. At what point should they start reaching out and building relationships with VCs? And what is the best way of actually doing that?
Yeah. Well, so a couple thoughts on this. One is I really think the best financing processes often start in the prior round, and in many cases start 12 months before you need capital. But let me maybe explain what I mean by that, and then we can talk about, what are the mechanics and, how do you kind of build the best relationships or strongest relationships. I think pitching VCs when you're not raising capital is a bad use of time personally. I think that, a lot of founders think that, oh, well, maybe we can do something preemptive and look, if that works out, then it's great. But often what happens is a VC will say, yeah, I'd love to get to know you, get to know the company, see if we can do something preemptive, right? And so then you open up your books, you distract the management team, and the
Right.
VC ultimately doesn't get there, right? Passes on the investment. And maybe even worse, even, in that situation, if they don't pass, now four or five other VCs have contacted you saying, "Hey, I heard you were raising, can I get the data room?" And let
Yeah.
me. So
Yeah.
now you're in a full-blown process without having ever thought you were gonna be in a process, right?
Yeah.
And so I'm not a fan of like meet a ton of VCs when you're not raising capital and like share a bunch of data with them.
Yeah.
I think the best thing to do is when you are raising capital, meet VCs, that are at your stage, maybe the stage, after you, right? And, multi-stage firms and that sort of thing. And cultivate those relationships, right? That doesn't mean that you're necessarily like reaching out to them after a fundraise, but, and sharing a lot of data. But maybe you're just keeping the relationship warm, right? Like, hey, let's grab coffee informally. We don't have to talk about metrics or numbers, or hey, I want to introduce you to, this friend of mine that is looking for a job or, raising capital or whatever. I thought maybe your firm could be helpful. Like just staying top of mind,
Right.
I think is a great way to do that, where you have someone that wants to learn about the business
Right.
at a time when you actually are fundraising. Even if they don't get there, they could be an investor in the next round. And so from a time investment perspective, it's a very efficient way to do it, right? Like my biggest piece of advice is like the next round actually starts, planning for the next round starts in your prior round, right? And so you just have to take a very long-term view on a lot of these things and build relationships in very time efficient ways.
I agree with you. So when I'm thinking about relationship building between founders and VCs, I also see like a multi-stage funnel because in the end, it's same sales process as if you would acquire, for example, an employee or a customer or an investor. It's basically just okay. You need to acquire a specific stakeholder who can help you grow the business. And if you think like that, then you can still have a very simple relationship building method. For example, if once you've identified the 20 top investors that might be relevant for your sector, geo, etc., etc. You would also fit into their portfolio and so on. And then you basically try to get in touch with them, either by a warm intro, of course, this would be the best one, or somewhere else. Trying to have some kind of small trust building interactions. So, could be, for example, hey guys, I just saw you invested into a specific other Gen AI company, if I would be having an AI company, and then say, oh, I would love to chat with you on your take on the AI industry because we are building something else, for example, or maybe just quick updates just to build a trusted relationship and showing to the investor, yeah, we are currently not raising money, but I want to start building a relationship because I know if we are growing faster and we are in cash need, maybe in 12 months or in 15 months or whatever, at least we would have some kind of touch points before then. Yeah? And then you might already be like 6 months, 9 months in the loop and see the progress that I said we would be making. Maybe if
Mhm.
it's just every 2 months or 3 months an update or whatever. Thereby, you are not sharing detailed financial information and so on because, like you said, this would be overwhelming because then you would be wasting your time as a founder once you've built like 3 4 months of a relationship before that, and then you would be saying, okay, guys, now we are starting
Yeah.
raising funds and would love to hop on a call or a meeting or something like this. So then the investor is like, let's say, pre-warmed. It's the same like with lead nurturing, basically, but for VC. So, I mean, if you look at a VC firm, depending on the asset under management and team size, sometimes you have like only maybe one or two partners. Sometimes you have like 20 different partners with 50 associates, etc. How do you get in touch with the right person in a VC that is helping you to raise more money at a higher percentage of likelihood?
Yeah, I think this is one of the things that I see founders make mistakes around pretty often. I often get these emails from founders that will say, "Oh, could you introduce me to TCV, as an example. Okay, well, it's a big firm. Who in that firm do you want to meet, right? And so that's one aspect is who within the firm is the right fit, and we can double click into that. And then the second is you want to make sure that the relationship between the person that's introducing you and the person you're trying to get to is a strong relationship, right? Because if I introduce you to someone that, I met once for, at an event or something, and they barely, recognize my name, well, that's a very weak introduction, right?
Right.
But if I introduce you to someone that I'm on a board with, or that I've done investments with, that's going to be a much stronger introduction, right? And so I think, and well, let's double click on how to navigate that in a second as well. But going back to the first part of getting to the right person, I think what you're trying to look for is who are the partners that are investing in your sector and stage. That's probably the easiest thing. The way I would understand that is looking at the website, reading the bios, seeing the deals that they're invested in, right? Two is, are they actively investing, right? And this can be a little tricky, right? Because you might have someone on the website, but guess what? They haven't done a deal in 2 years or 3 years, or they're entering retirement. So looking at Crunchbase to understand, or, pick whatever database, like looking at some of these things to understand when was the most recent investment, right? And are they still active? These are probably the best ways to getting to the right person within a firm, right? And then in terms of finding a strong introduction, I think when you ask people to make the introduction, don't be shy or don't hesitate to ask, not just could you introduce me to this firm, but who within this firm and what's your level of relationship with
Yeah.
this person, right?
Mm.
And I think what you want to do is make it very clear to maybe the investors that are helping you or your advisors that are helping you, or just, your network, that, hey, it's okay. Like, don't feel the need to say yes, 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 yeah. I can introduce you to all these firms, because if you don't have a strong relationship, I don't want to bother you to make that introduction. I'll just go find someone else, that can make the introduction who
Yeah.
might have a stronger relationship, right? So I think a lot of it comes to, really not just asking like the surface level question of who,
Yeah.
which of these firms do you know? But it's like, okay, well, I've identified that I want to meet this person at this firm. Do you know them? How well do you know them? And then, you just skip. If someone says, I don't really know them well, I could send them an email, but, you just, skip that and try to find a stronger introduction.
Can you give us some insights on the closing time? So from startup reaching out to you and saying, "Hey, I'm in the process of raising some funds," and maybe you can distinguish between seed, early stage, and Series B, for example, and the time when the money is actually on the bank account. So, and how long does it take right now in the market?
Some of this depends on just the quality of the metrics and company, but I would plan for 3 to 6 months from start to finish, right? I think it's safest to plan for 6 months, and if it happens shorter, that's great, right? What I would tell you is it's right now in the market, depending on the quality of the company, it probably takes like 3 to 6 weeks to get a term sheet, right? Maybe a little longer, again, kind of depends. And then at least a month to close, right? And so if you kind of do that math, you're sort of at like 2 to 3 months, right? And I would say that that's on the fast side, right? Like that's like, you have good quality metrics, you've done all your preparation, like who you want to pitch and how you're going to get the intros. You could very easily see it being 3 to 4 months. And then, if you haven't done a lot of the preparation, that preparation work will probably take a month in and of itself, right?
And what other things are there for founders to shorten this time of period for raising funds? Because nobody, let's be honest, is liking the process of raising funds, yeah, because you actually want to grow the business. But if you are spending your time and resources on fundraising, then you are have a very limited attention of actually growing the business, which is also maybe lowering your annual growth rate, for example. And then you need to balance this. Okay, would I rather want to spend time on my business and then maybe improving my metrics, which might be increasing my chances of raising money? or do I want to really pin down and be fully committed on fundraising? I've seen some really crazy stories, even from big startups raising like 30, 40, 50 million dollars, and they were on the road full time, like 12 to 15 months, and
Hmm.
basically not really involved in the daily business uh, because this is how much time they spend on raising money. So then the question is, how can I shorten this period so I can actually focus on growing the business?
I think the best way to shorten the process is to be very well prepared for the process, right? So, really to have that plan of who you are going to pitch, how you get the intro, have your deck ready, have your data room ready. Like, those are the things I would say the best thing that you can do, right? I think the other piece is so that work, by the way, if you're doing it right, probably takes 1 or 2 months in and of itself, right? Just getting your deck ready, getting the data room, building the spreadsheet of firms that you're going to pitch, all that stuff. The other thing that I think I see founders make the mistake of is not being intellectually honest about, what is exciting about the business, but more importantly, what will cause hesitation. And I think often founders can take this approach of, well, no business is perfect. We're not gonna be explicit about maybe the things that are not working
Yeah,
well, And I think that's totally the wrong thing to do. What you want to do is control the narrative, right? And basically say, hey, look, this is what's compelling about the business. By the way, here's what's the challenge, right? And here's my plan of how I'm going to mitigate that, right?
right.
And so I just think, you almost want to lean in to what you think some of the questions are going to be and address those before the question is asked so that you can control the narrative. And rather than like wait for the question to be asked and then, people start to wonder, hey, maybe this is a bigger issue than I think.
I mean, if I'm looking at startups, it's like you need to communicate a story which shows that you're good at risk management. Because if you're
That's
very
right.
early, you're building a product, MVP, etc., then of course you also need to identify what are the critical assumptions that I'm making that could make or break my business. And the same if I'm a little bit later, got the first 100 customers and so on, and then I'm like, okay, what is the most critical assumption right now? Okay, I don't have a fucking clue how I can get 100,000 leads a month. I don't
Hmm.
know because I'm a tech
Yep.
founder, for example. And then you could say, okay, what did you do to de-risk that? Yeah, okay, I
Hmm.
talked to 20 marketing guys and they told me this. I hired, I don't know, a middle management marketer who did some kind of very early A/B test, resulting in this metrics. Does not look very promising, but he said if we do some A/B testing or experiments with some other marketing channels, might be working. Yeah. But this is definitely the biggest challenge. So if you, as an investor, has some kind of people in your network who we could talk to, this is what you told me like 20
Hmm.
minutes ago, then this might be helpful. Yeah. But at least then you know what are we good at and where are we really bad and we need help. And nobody knows
That's right.
everything. Yeah, but you need to know, okay, as a founder, if I do not have this kind of skill also in my team right now, you need to either talk to some other people or try to get those people into your team because you know you need this kind of type of skill in order to grow further. What type of data are you looking for in a data room? So, what type of documents and so on should founders prepare?
So there's all the legal diligence stuff, which honestly you'll have time post term sheet, right, to put a lot of that together. So I would be prioritizing the business diligence, and that would be, things like your financial plan, right, your pipeline, any key customer or BD contracts, or anything kind of germane to maybe how you have scaled the go to market. I would be putting maybe team management team bios, a cap table,
Yeah.
have all of the things that, a customer, a sell deck, right? Of the materials that you use that are customer facing. Have all the things that you think, someone is going to want to see to understand the business better, right? You don't have to go overboard and pull all the legal diligence stuff. That like I said, you're going to have time to do that. But really, it's more of the business things. And look, there's a lot of focus on, kind of the model and the financial piece, right? Because I think that is something that investors are usually looking at to
Yeah.
gauge, like, hey, do you understand the levers of the business? What do you need to believe to scale the business?
I mean, I would want to see that, but the question is whether investors always want to see that. It's basically a historical product roadmap, maybe plan versus actuals. And then, of course, what I would want to see, like at least maybe a 6 or 12 months type of product roadmap, of course, in different
Mhm.
granularities. I mean, if you're looking at the 1 month, 2 months, 3 months roadmap, it should be very, very detailed. And then maybe if you're talking about 12 months or 3 years roadmap, should be a little bit more high level, but at least still seeing what type of metrics are trying to move with this type of product investments.
Yep.
Is this what you also would want to see in the stage one data room, or would you rather wait in the stage two?
Yeah, no, I think it's definitely more stage one. Sometimes the product roadmap's actually in the pitch deck, right? So
Yeah.
even before the data room, right, you might consider, especially depending on the stage of the business, like you might consider putting some of that in the deck itself, because there may be questions even in those, first one or two meetings about, product, not just product direction, but product velocity.
Yeah, yeah. But I mean, if you're putting this in on a slide deck, it's like one slide, so extremely high level. What I'm talking more is like, for example, if you are have you an very early product and you want to understand, are they really efficiently improving the product? Because that's why you're increasing the value that you are delivering to customers. And then I would want to know, okay, are they really good at setting OKRs, for example? Or what is the hit rate of what they said they want to build? Are they even measuring this? What type of other product metrics are they measuring or looking at in order to allocate the capital that they are investing in? Are they measuring, for example, employee productivity in product and maybe some other functions as well, of course? For me, I would want to get a feeling of, okay, is this founder guy building a really highly efficient organization, which is based on data and OKRs and so on and so forth? Because if I'm giving him money, I want at least feel good that my
Mhm.
money is used in the most efficient way that the founder can do. Yeah? I mean, of course, you can maybe improve, and maybe you can give him some OKR coach later on next to it, or maybe you can hire a more experienced executive and so on, and put him as a buddy wingman or something like this to improve this kind of efficiency. And I don't want to with you to feel like okay, it's just about efficiency if you are in a startup. No, in the beginning, of course, it's not. But even under uncertainty and so on, given all the information that we have, you still should choose the most efficient path and fastest path to likely success. Yeah, even if it's very uncertain.
Yeah, and we love to see the OKRs and love to see how companies think about goal setting because to your point, it's not necessarily that you're looking for a specific thing in those. You're more looking, does the company have the structure and discipline? Like, do people know what they're doing? Are they being thoughtful about what they want to achieve and how they're going to achieve it and the pace of how quickly they're moving, right? So we love to see that.
And when you look at financial models, for example, when I'm building financial models, I always love to do it as granular as possible. What I mean by that is still it should be super easy to understand and so on, of course, yeah, and should be easy flowing the model so that you make sure, okay, there are not no logical errors in it and so on, and that you can easily communicate it. But what I really like to do is like building an operating model, so really showing like, okay, how does the customer acquisition actually work? And then only doing the financial model because many startups I still see the typical investment banking approach of like, oh, we're
Mhm.
doing whatever 100K monthly revenue and we assume we will be growing by 10-20% year on year. Okay, and then this is how our margins will improve. Okay, how? Yeah, this is the Excel model. It tells you that we are doing that. Yeah. So
Mhm.
there's no clear path on, okay, communicate, because I always think like the financial model and your growth story, they need to be very much aligned. Because if you're telling me on the in words, basically, yeah, first we want to enter the US. We mainly focus on email marketing outreach, for example, because we want to get to whatever 5 million in annual revenue there. But then, okay, this market channel is used up. We need to expand into additional ones. Okay, we already pre-validated. We want to go, for example, Facebook ads or some
Uh-huh.
other thing. Yeah.
Uh-huh.
Okay, which can help us maybe scale to like 20 million. Okay, and here's how the customer acquisition mechanics then work. So we want to spend like this type of budget in there. This is how much the lead costs will be. This is how much the customer acquisition cost will be. This is also how much the retention will be, etc., etc. So that I can clearly, as an investor, go through the deck and say like, okay, I really understand. The person doesn't need to tell me anything. I can clearly see what is happening, or at least planned to be happening over the next 1-2 years. Where is this found planning to invest money in? Because I can
Yep.
clearly see it. Okay, now he's want to add this marketing channel. Boom, 500K. Now he's adding this marketing channel. Okay, another 200K. Okay, should be translating into this type of revenue. Okay, understood. And here there's some key hires. Okay, key hire 1, key hire 2.
Mm-hmm.
Okay, I really understand what is this doing, and I also have some kind of understanding. Even maybe it's not very necessary for the financial plan, but if you have a high level product investments, that you could also communicate. This is not super necessary. Yeah, you can
Yep.
see this maybe through the headcount, but at least you could support this kind of investment story that you are communicating as a founder to investors. Again, most financial models that I still see, they are not using an operating model. They are
Mm-hmm.
mainly just they start with revenue forecasting, but not a granular one like cohort
Yep.
analysis or something like this.
Totally.
And then, I mean, if you don't do cohort analysis and modeling, for example, good luck with hitting your LTV and CAC predictions.
Yeah, totally, totally. I mean, I think you want the model to tie to, what the business data is showing, right? In terms of what it's costing you to build pipeline, how you're converting that pipeline, how customers retain, right? All of these
Yeah.
things, what you need from an OpEx perspective to support a customer, right? All of these things that the business is showing you that it needs, you want to ideally see that baked into the model and not just some like 10% month over month growth factor,
And if you look at like subscription-based business models, which
Mhm.
are not very, let's say, capital intensive in terms of you're building up a huge balance sheet, because it's not like e-commerce where you're having a bigger balance sheet compared to a SaaS company or something like this. Would it be totally sufficient for you to just look at the income statement, assuming that the cash inflow is anyway between 2, 3, 4 months, or would you rather say, okay, no, I definitely want to see all 3 financial statements, or would you rather say, no, it's fine to have an income statement plus a very, very simplified cash flow statement?
Yeah, so I think that's okay at a seed round to have an income statement, P&L, and maybe a light cash forecast, right? I think that's okay. I think ideally you want to get to a three-statement model, really because a lot, even subscription businesses, right, might have annual upfronts or things around cash dynamics
Yeah.
and deferred revenue that could be favorable to the business, right? Often in subscription software businesses, that is the case. But you just, I think, want to be able to get to a point where there's no surprises particularly on cash, right? Because, at the end of the day, regardless of what maybe the P&L says, cash is king, and, you just don't want any surprises around how you're doing runway forecasting.
If you look at the startups reaching out to you and saying, okay, we are raising money, what is that typical run rate? Because they said like, okay, best practice, and we agree with that, is talking to investors as early as possible, so you're not at risk as going bankrupt, because most of the time
Yeah.
it take longer than you think. But what do you see typically? And do you have some really weird stories where somebody said like, oh, we only have like 3-4 months runway, whatever, maybe bad planning or some kind of financial hiccups, I don't know, which they did not plan for. And now they're reaching out and saying like, okay, actually we are back against the wall. We only have like 2-3 months left. Is this something that you're seeing very often, or is it more not the norm?
Most of what we see is 12 to 18 months of runway before they, come to market to raise a round. And I think that's good. That's a good position to be in. We do from time to time see the company that has kind of like 3 months of runway left. That's a really challenging position. And I would
Yeah.
just tell, founders in that position, you should be having the conversation with your existing investors around bridging the company. Sometimes maybe the existing investors won't bridge the company. So, you're in a difficult position, but you just kind of have to do what you have to do. But I think if you're in that like 3 months, I would start with talking to the existing investors, then start talking to, kind of potential new investors.
So that you at least can communicate to the potential new investors, hey guys, our round is already 50% subscribed or something.
And you can say, yeah, I have 3 months of runway, but my existing investors are willing to, kind of pre-fund, their portion of the round. So I'm not worried about it,
Yeah.